It's Jarrin and Krystin here with the Portland Home Market Real Estate team in Portland, Oregon. Working with a lender to get a pre-approval is really the first step in the home buying process.
A pre-approval letter is the ticket you need in your hand in order to put an offer in on a home. Getting this pre-approval in advance can save everyone a lot of headache and hassle when you actually do see something that you like.
Today we have Mortgage Advisor Addy Nett, the founder of the Podcast Channel Modern Loan Officer, or MLO. Addy is known in the community as one of the top producing loan officers in the Portland and Southwest Washington areas. All right, Addison, thanks for being here. We're looking forward to chatting with you a little bit about kind of what the lending process looks like and why it's important. So first and foremost, pre-approval, pre-qualification, how do we get all that started and why is it so important?
Yeah, Jarrin, well, first of all, Krystin, Jarrin, thanks for having me today. I appreciate it. I think one of the most important things to understand in the lending process is there's actually 3 different stages to starting your application and securing your financing for a home purchase. So you're going to see a couple different terms out there: pre-qualified, pre-approved, and pre-underwritten. So depending on what search engine you use or how you Google things, you're going to find different answers all over the place. But pertaining to our market specifically, the 3 different levels start with pre-qualification. So I always define pre-qualified as someone's going to take that initial step to fill out an application. Nowadays, it's typically done online or on the phone with a mortgage advisor or a licensed loan officer. Mm-hmm. So a pre-qualified is basically just going to be your intro. You're going to fill out your basics, living history, work history, income, your access to funds, so savings or investments, and just basically off of that information provided by you, an advisor or company is able to give you somewhat of an estimate or a range of approval based on that information.
Great. And then we take that and we sort of, and we hope that aligns with where the buyer's or budget currently lies. But then in order to write an offer, we need an actual pre-approval. So how do you go from pre-qual to pre-approval?
Yeah, great question. And I think that's where a lot of people, especially first-time home buyers, get tripped up, where it's like, already went through the pre-qualification process. However, that next step, graduating from pre-qualified to pre-approved, is really coming down to supporting all that initial information that you put together with loan documentation. So, for example, if you say you have $30,000 to put as a down payment and apply toward your closing costs, we are going to support that with bank statements, and typically done with the most recent 2 months. So you're supporting everything you said on that application with actual documentation, which includes, but it isn't limited to, most recent pay statements, your tax returns, W-2s, business tax returns if you're self-employed, a profit and loss statement for the year. So that is the big jump from pre-qualified to pre-approved, is supporting it with loan documentation.
All right, Addy, can you just walk us through what types of documents buyers need to get in order to start moving through the origination process?
Mm-hmm. Yeah. So when it comes to going through pre-approval and even pre-underwriting processes, some of the things that applicants can do to be prepared is assemble their short list of initial documents. So that would usually include, let's just assume the applicant is a W-2 employee. You would want to grab the last 2 years W-2s, your most recent 2 pay statements, your most recent 2 bank statements supporting the down payment and funds for closing. That right there really is the nuts and bolts. It gets kind of deeper with your ID, front and back, and other exhausting, minute documentation. But the W-2s, pay statements, as well as your bank statements really allows for a loan officer, a mortgage advisor to do a decent, accurate job of originating a pre-approval and getting ready for pre-underwrite.
Yeah,
Makes sense.
Go ahead.
Well, I was just going to ask a question. So as far as like employment history, let's say you've recently changed jobs. Is that something that that could potentially stand in the way of you getting a loan or affect your terms?
No, that's a super good question, because I think there's a gray area. So there's a lot of dependency on the loan product, but generally speaking, and it's funny that you bring that up, because before my wife and I bought our first home, we literally didn't apply for a mortgage because we hadn't been at our jobs for 2 years. And I had just heard at a backyard barbecue that you needed to be at your job for 2 years.
Yeah.
So that's not true. If you have been at the same job for 2 years, it certainly makes it a lot easier to at least explain the story to the underwriter. So I like to make it generally, if you zoom out a little bit and make it less complicated, an underwriter needs to demonstrate that you have job security and continuance of your income for 3 years. So say you are working at Nike for 4 years and then you switch to Adidas, and now you're working at Adidas and you just have the same salary. That's fine in most cases because it is the same industry job. You're not going from being a CEO to, working on the front lines at Starbucks. Mm-hmm. So as long as there's a reasonable explanation for the job change and there's not a big gap of employment, that's the biggest thing. Typically, underwriters are going to be pretty gracious between 30 and 60-day gaps with a reasonable explanation. Like, hey, we moved from Texas to Oregon or California to Seattle, or we had a family instance where I needed to go take care of my parents. Those are all reasonable explanations that an underwriter is going to understand and in most cases move forward. So the biggest change, and sorry to get long-winded, the biggest one where it becomes more complicated, though, is when you're self-employed. There's less leniency on the self-employed bar.
Well, that's a good segue, because the other thing we wanted to talk to you a little bit about is what program, like any new programs that are available right now that maybe people don't know about that they could be taking advantage of. Can you just talk to us about what you're seeing out there right now in relation to conventional versus FHA, and maybe even we just differentiate them a little bit too, just so everybody understands the different types of loans available?
Yeah, no, that's a great question, Krystin. So just to kind of break down what the buckets of products are. So we've got a conventional loan. That's essentially your gray goose of loans. So it's the least amount of guidelines. It typically has the best APR and interest rates, the lowest amount of fees, and it's commonly presented as the best loan product when it comes to an offer to a seller. The least amount of contingencies on the property conditions, which is appealing to a seller. So that conventional loan also comes with tighter restrictions to qualify for it. So a higher credit score than some of the government loans. For example, a conventional baseline Freddie Fannie mid credit score is 620 versus FHA demonstrates typically a 580 minimum credit score.
Oh, okay.
So that's a big deal right there. So within the conventional world, what I've seen a lot of changes to is that 620 to sub 700, so 699 credit score is really being heavily adjusted right now. And adjusted meaning the interest rate is a lot higher than it was a year ago for that credit score, because rate is heavily dependent on a lot of different factors, but mostly on credit score. And the reason being is we are in a volatile economy. We're in an uncertain future of where the country's going to be, what businesses are going to float and sink, how are we going to evolve as a country, right?
Yeah.
So the investors are leaning a little bit more toward a polished applicant from a credit standpoint, and you're seeing some pretty heavy interest rate adjusters for that 600 credit score. Transitioning to the government loans, there is the FHA loan, the Federal Housing Administration, which is an excellent program. I always try to figure out a long-term plan for people to be in a conventional loan if possible. But in many cases, FHA is the right way to go for some people. There's a shorter wait period on previous bankruptcies. There's a lower credit score requirement. There's also lower interest rates for government loans, typically speaking. Now, the one thing that frustrates me is I don't feel like loan officers and mortgage advisors do a very good job at explaining what you give back to have access to that program, meaning what are the fees, what are the closing costs, what are the discount points or charges associated. For example, FHA right now has a 1.75 fee that gets rolled into your loan. So you actually have a base loan amount and a total loan amount that you're paying on. So 1.75 to some people say they have a short-term strategy of just wanting to be in this home for a couple of years. You're forfeiting around up 2% equity before you get keys. So 2% equity to some investors or people wanting to become an investor and start building out a portfolio or flipping, that's something that needs to be accounted for. Because if you're selling and you've already lost 2, that's a lot of percentage, anywhere from 4 to 7% that you didn't factor in. I'd say lastly too, this is a loan that is dear to my heart and for many reasons, and I truly enjoy doing it. Another government loan would be the VA loan, which is for veterans, people who've served our country. They have an incredible opportunity to get into a home as long as they qualify with literally 0 down payment. And the VA covers the insurance premiums to allow for that to the investor. There is no mortgage insurance on a monthly basis for the veteran. So you're going to see lower payments, lower interest rates. Additionally, a lot of flexibility in how incomes and liabilities from a debt perspective are perceived. Significantly less harsh than, say, conventional as well as even FHA scenarios. So I absolutely love the VA loan. I love taking care of individuals and being an advocate in our local community because there's a ton of misperceptions in the real estate world, depending on the market that you're in, of it being a competitive product. However, I've done many podcasts and interviews with VA appraisers talking about how the VA is aggressively working to always improve. So their entire goal this year is for a VA loan to be just as competitive as a conventional loan. And I would like to note lastly too, for anybody out there, whether you're working with Krystin, Jarrin, myself, or other people, a growing trend in a very competitive market with VA is sellers, for some reason, look at 0 down products like VA as they don't have as much skin in the game. And there's a way to combat that. You can actually be proactive in communicating with the sellers, because a lot of the veterans are very, very financially savvy. Like, they're saving money. They have a lot of retirement funds. They're very well qualified in a lot of situations, and you could have you could demonstrate that proactively by communicating with the sellers. Be like, look, we could do a down payment. We're just utilizing this great benefit that we earn serving our country. And I've seen a lot of people overturned all because of them just assuming on a piece of paper that, oh, it's 0 down. They don't have much skin in the game, so we're going to look at a 5% down over this.
Totally. I want to ask a little bit about the difference between a loan originator, a mortgage broker, banker. Like, do you go to your bank? Do you go to the broker? What's better? How do you break down? How do you shop around? What should people do here?
Yeah, no, that's a good one, Jarrin. I get this quite often. Like, I mean, even my own friends will call me like a mortgage broker, and I'm not a mortgage broker. So and it's very confusing. So to break it down to something that's distilled and easy to take away, I'd say you've got 3 primary different options when it comes to choosing how you get a mortgage. So starting with number 1, let's just start with banks, right? You've got big banks, you've got community banks. Those institutions are typically going to be a very big shop, meaning that they're doing more than just mortgages, auto loans, checking, savings, business accounts, home equity lines of credit, home improvement loans, recreational vehicle loans. So the banks are opening up a lot of different services, if you will. So one of the perceptions, at least within the industry, is they just have a lot going on. So you're going to someone very general at a big bank, so you're going to see kind of a slower response time typically. You're going to fill it out online and most of the time just get into a river of a queue. So your application will be addressed at its time received, if you will. Yeah. Versus if you're looking at a broker or a private mortgage bank, which is what I work for, you're calling our cell phones. It's our job to hustle and have that bedside manner and be available outside of normal business hours. And there's some advantages and disadvantages to that. So,
I mean, I got to tell you, in my experience, I get a new client and they say, I say, where are you at with your lending? And they're like, oh yeah, we've already gotten our pre-approval from XYZ, like top 5 biggest banks in the world. And I'm like, well, we're not going to hear from them on the weekend when it's time to write an offer, and you know what I mean? So, and that's why, like, I don't want to name names, but honestly, like, if you're going to go to top 5 bank and get a mortgage, it's hard to be competitive. I mean, I know that the one thing that sellers can discriminate over is your lending. They can't discriminate on who you are, what you stand for, where you came from, anything, but they absolutely can discriminate on your lending. And I've literally had listing agents tell me to my face, yeah, we chose this other offer because they had a local bank or a local lender or whatever. And it does make a huge difference.
I will add to that too. I mean, from a perspective of a bank too, my experience personally is the initiative that banks typically want you to do their mortgage with them is so that they can have access to all your other financial fundings and transactions. For example, they want you to have your payroll deposited there. They want you to have all your investment accounts there. So their system is all about getting you to funnel into their bank and not necessarily the focus of what's your experience going to be like buying this home. What is the trust level? What is the expertise of structuring your loan accordingly and getting to know you and not only your family and personal goals, but your financial situation. So it's just a totally different experience, really. But there are some advantages. Like you will see some very, very aggressive promotion rates from banks, all under that strategy of trying to attract your finances to their institution. One example primarily are jumbo loans. So loans that exceed 5, 10, 400 this year. You'll see different banks fluctuate of wanting to attract those type of high income earning bankers with very, very essentially break even in some situations, a loss for the bank mortgage. So there's some advantages to using it. However, in a competitive market, as Jarrin and Krystin always like to explain to a lot of clients, is we need every competitive edge that we can to have our offer accepted. So hopefully that's the bank part of it. So I wanted to hit all the buckets. Any other questions though, just with the bank? So transitioning from banks, so people that are sitting in actual physical branch locations to mortgage brokers, which is the most commonly used term, whether someone is or not. Brokers have a unique ability to essentially outsource the entire process to any company that they want on the back end. And when I say the back end, the minute you have an accepted offer and the process and underwriting to close is a variable. So if you go to an insurance broker, right, they're going to say, okay, looks like we could go State Farm, Geico, Progressive. These are all the different pricing for those 3. That's what a broker does, is allowed to bring a lot of different companies, which you could essentially, in a lot of cases, find a very appealing term, meaning interest rates, sometimes lower fees. However, I've learned that the broker also sets their own compensation within the structure. So you're going to see like a very common 1% origination fee from a broker or a 2%. So that to me as a consumer is the unappealing thing, is like, I don't want to pay you 1% to shovel my loan off to whatever company. Other downsides would be the control of the transaction. When you are just picking the best deal out there And you're sending your file from accepted offer to close to a team you have no relationship with or control over. So there's no ability for the mortgage broker to call and be like, hey, could you really do me a favor and I've noticed no one's touched this file in 2 days. We got to close. I need this to be final approved, clear to close, docs out to escrow. You can't call anyone. You are queue based, just like the bank.
Yeah.
So there's throws. Like sometimes you can get really awesome terms on the loan. Sometimes not necessarily in this market right now, but historically speaking, they also have access to some really cool brokered programs for like bank statement loans or short-term lending, really unique products that aren't as cookie cutter. So there are some advantages to using the broker side, but I think the most important thing is the loss of control of where your file's at and when it's going to be closed.
Yeah, totally.
Lastly, let me hit my position. So on the private side, you have a mortgage company. So I've worked at banks and mortgage companies. The only thing I haven't done is being an actual mortgage broker.
Yeah.
But working directly for the private mortgage company, all they do is focus on mortgages. So that back end process is typically all going to be under one roof, one company, often in one office. And then you have your representative mortgage advisor who is out there and working to the flexibility of your schedule.
Yeah.
So kind of what you're seeing is from a pricing standpoint is typically in the middle of what you're seeing from high to super low. So the private mortgage banks are wanting to be in the middle where you get this extremely high service and a very, very fair term on your mortgage. But in return, you have people working for you, people on the weekends, the evenings. They're looking at your file from a personal standpoint. And often just people that take the time to do that in my occupation are in the long run saving their clients money. Like I'm available. I was able to help get them in contract. I was able to save them thousands of dollars because I didn't make this mistake or I looked at it from this perspective. Or even to your point, lastly, Jarrin, when you were like, what do people do with $300,000 liquid? I don't have a job. Like if you go on to .com, probably shouldn't have used that, a bigbank.com and just apply and you put zero income, they're just going to say, sorry, we couldn't approve your loan in an automated email. Versus like Krystin and I have had many conversations where we're like, okay, well, maybe we could do ABC. Let me look at that. I also know other people at different companies. I can connect you with that person. So depending on how you look at service and what's valuable to you, that's how you need to decide who to use.
I mean, Addy, you and I recently had a client where you took a pile of cash that they had, put it into a retirement account that paid them monthly, and we created an income stream for them. Whereas they would have been in that scenario where they had cash but not high enough income to qualify for the home that they knew they could afford. So we created that affordability and that service. I mean, that's the service that you're talking about.
Are you still seeing? I remember, especially back in the 10 years ago, adjustable rate mortgages were huge. Are you still seeing a lot of ARM offers? Or is that still something that people are taking advantage of versus like your standard 30-year fixed?
Yeah, so great question. In the last 5 years, I've seen one ARM completed, and they're typically done in really high loan amounts that are around $1 million or higher. A lot of those individuals don't plan to carry the $1 million mortgage for a long amount of time. They're like, hey, I'm going to sell my business in 2 years, and then I'm just going to pay it all off. So ARMs are usually utilized a little bit more as a bridge loan with anticipated assets coming in. But right now, even in the last 5 years, interest rates have ranged from 3 to, at the very highest, around 5 for a conventional typically. So there hasn't been too much of an advantage to risking a variable rate, which could change in 5, 7, 9 years when rates are already super low. So they'd rather lock it in for that longer extended time, most customly 30 years.
Let's transition into how to we've gotten pre-approved. We start house shopping. Now we've identified a property. So we send the property to you. We get a quote back. What are all the closing costs and what are all the details in that quote that we want to look at, and what's that going to look like? Like what can we expect? What's our out of pocket too?
And before I dive into those details, I would like to just suggest anyone out there, especially first-time home buyers, don't overlook trying to understand closing costs and specific to the property that you're offering on. Because I see a lot of people who don't work with me or even friends, they tell me about their experience, which I love hearing. It's like, oh, I got approved for $500,000, and they're just out with their agent. They find a house for $400,000. They put an offer. They don't have any real idea what the monthly payment is and what the closing costs are before they offer on it. I think that's the biggest mistake, and one of the reasons why I got into mortgage is like that's how my mortgage person dealt with me. Like, I couldn't reach him. I had no idea what we were doing. It was all like, well, I think it's going to be around $2,000 to $3,000 a month and this, and I didn't know my options. So I just strongly encourage people, if you're out with Krystin and Jarrin or your agents, whomever it is, have them communicate with your lender. It should be a team effort and be like, hey, we're looking at this property. It doesn't take long for a loan officer to pull up that address, verify the taxes, get a decent estimate on insurance, refresh interest rates for today. Because if you did a pre-approval 60 days ago, terms and interest rates could be completely worse or better.
Right.
Yeah.
Right.
And it's super important, especially as a first-time home buyer, to understand those factors.
Let me just interject one very, very common correction that I have to make in people's sort of perception of the mortgage industry. I got people all the time call me. They're like, oh, yeah, we've been approved 3 weeks ago at a rate of 2.95, 2.8, whatever. And I'm like, well, that rate was old 2 days later. You know what I mean? So, like, it's super, like, if you're going to shop between lenders, you have to give both lenders or three lenders the same property information on the same day, the same purchase price that you intend to offer, and get side-by-side comparisons on that day. It's the only way to actually compare apples to apples.
Oh, 100%. And to just add to that too, you got to look at the APR versus the interest rate, because the APR accounts for the total cost to obtain that rate in the terms, which includes that buy down we were talking about. So just because any loan officer in most situations could write any rate that they want, but if they're not properly disclosing what costs it take, like say the par rate, meaning this is what I should give you at no additional cost, say it's 3.75, just for example. Yep. I could write, you're approved at 2.99 and write it in on the letter. But if I'm not disclosing an estimate to you, you have no idea that I'm also adding $15,000 in closing costs on top of the already $10,000. And now you've got $25,000 in closing costs, and you wanted to do the 3% down first-time homebuyer program. So there's, unfortunately, the reality, and I hate to throw my own industry under the bus, unfortunately, the reality is it's really easy to skip steps to make the consumer look like they're good to go and they have an amazing deal just so that they stick with that individual. And to Jarrin's point, you aren't creating apples to apples if you're not looking at the same property address on the same day. And then lastly, huge misperception, you do not have those terms locked. Is the term locked? Your interest rate is not locked until your loan officer does it after you have an accepted offer. I've seen some companies offer what's called like a floating lock, meaning you can't get any worse, but those have really gone out the window because the market's been so volatile. The minute you lock, you're good to go. If interest rates go up, doesn't matter. You still have yours. If it goes down, unfortunately, you don't get the lower one either. That's another really common question. But But yeah, anyone could write up any interest rate and just be like, oh, interest rates have changed when you come around and have an accepted offer. You thought you had 2.99, now you're looking at 3.9.
Right.
Yeah.
Let's talk about maybe some other just pitfalls that people fall into in relation to like taking advantage of forbearance programs, just like red flags that a lender might see that people, unbeknownst to them, are maybe not setting themselves up for the best offers.
So I think it's a really, with June 2020, right now we've had quite a bit of a year. So with the pandemic, we've had unprecedented and uncharted waters when it comes to lending institutions. And as a mortgage advisor, I think the number one thing I could reiterate and communicate is every lender, company, servicer, the person you pay your mortgage to, is really the staff holder of the term. So they're going to decide, hey, what does it take for you to be requalified? Generally speaking, with forbearance, that is very, very tricky. We're mostly going to see, generally speaking, and it's company to company, a 3 to 6 month back on track history, meaning like, okay, I've made 3 to 6 months payments, I'm good. Some lenders I've seen 12 months. It all depends on the investor and the company. I've seen a little more leniency, say, on revolving debt, student loans, and auto loans. However, we got to look at everything from the underwriter's perspective. They need to sign off on the fact that you're stable again. There's a probable history of there is a history of making on-time payments, and there's a probable continuance. So as of right now, June 2020, these guidelines are all brand new, and they're always changing every day per the investor's threshold of risk. Yeah. So communication's the best thing. If the best thing you can do if you're unemployed right now is to be communicating with your employer and at least being familiar. Is there a rephase back into employment plan, or do I need to shift my career and start something else? The biggest is like, how long do I need to be back to work, right? I'm getting that question all the time, and I'm getting vague answers from underwriters too. And they're all coming back to, we need to demonstrate that they're going to be gainfully employed moving forward without any risk, essentially. So underwriters are pushing back to me saying like a lot of it's going to be career-based, the type of occupation. So are you a commission car salesman, or are you a utility plumber whom services are needed at every household in the world? So it's going to be an interesting year or so. And I think there'll be a lot of kind of just one-off interpretations of stability from the underwriters and the companies.
Yeah.
All right, so let's go. Like, I want to talk a little bit about a scenario that we've seen from time to time. So let's say I'm a homeowner currently, and I want to now purchase a second home, whether that be to move my mother across the country, or maybe I'm interested in investments, and I want to leverage equity in my existing home. Can you talk about just some kind of tricks of the trade in order to help get that cash flow going, and also maybe debt to income and things to just watch out for?
Yeah, good question. So what we're referring to is say your house is worth $500,000. You bought it for $500,000 and you owe $250,000 on that home. So you're looking at what's referred to as 50% LTV. So you owe half of what it's worth. Loan to value is the acronym they're used for LTV. So you're going to see some banks offering home equity lines of credit and different ways to tap into some of the value of the home without even needing to refinance or doing a cash out or anything. So the big kicker on that one is have a lot of equity. So I get a lot of people who put 3% down on a home 2 years ago, and maybe their LTV is 95% at best. You're typically not going to find anyone that's going to give you a line of credit because there's just not enough equity in the home. Right. So I think it's important for people. You probably need at least 65 to 75% LTV to start looking at that route. There are some that allow up to 85, but right now the home equity line of credit restrictions have really tightened because this is June 2020, and when there was a pandemic, there was a flood of people trying to open lines of credit on their home so they have access to funds because they were uncertain of the future, right? So everyone's liquidating. But back to your question, there are some savvy moves, like say you pull $50,000 out of that 250 to 500 scenario we were just talking. You could utilize those funds toward a down payment on, say, a vacation home, which in some instances people can qualify for as low as 10% down on a second or vacation home. So there's a lot of crafty ways to use equity and not just let it sit there, because now you're gaining appreciation, you're gaining value, and you've got a lot of different options as you build your portfolio. Your sub-question to debt to income figures, that you really should work with your loan officer, or at least be really good yourself on understanding debt to income thresholds, because as you build out a portfolio, typically speaking, the debt to income ratio on the next property gets lower and lower. So that meaning like you can only get less of a loan as you build out your portfolio. So you'll want to know, what's my monthly payback in the terms on that home equity line of credit, plus my existing mortgage payment, and then what's the new one going to look like? I would want to know, hey, I would want to do the reverse math with my client on, okay, we're looking at a beach house, right? You're like, it's my plan. I want to make it the family beach house. We already go out there all the time. This makes sense. My grandma lives there, all that type of stuff. What is that price point going to be that is going to get you a beach house that's worth it? And then do the reverse math versus some people who get access to the HELOC right away. And then they're like, this is what we're working with. Not a big fan of shooting from the hip.
There's not any restriction on renting out that beach house if you bought it as a second home with less than 20% down, is there?
So when you actually buy a secondary home, it needs to primarily, per guidelines, be your vacation property. That is the deal. Now, I'm seeing a lot of people utilize it as a vacation property, and then maybe they're away. They are using it as a VRBO and supplementing some of the costs. But technically speaking, you do sign this plans to be my vacation home. If it's not, and it's not reasonable, it turns into an investment property, which has significantly different terms and minimum down payment.
Very cool. But you wouldn't be able to claim any of that income towards qualifying for that second home.
No, not in that situation. You could use rent schedules for longer term rentals if it's an investment. Yeah. So that's a very common thing. Like you're buying an investment property, you can request for the appraiser to get rent schedules, and you can utilize some of the average rent proposed toward additional income for you to qualify. It gets a little bit trickier in those instances. However, I always like to work with my clients on their goals, and we never want to put people into a position where, oh my gosh, if you're dependent on hypothetical rent schedules, I wouldn't be very surprised, regardless of which company you work for, if there was a heavy overlay of reserve requirements, meaning another asset account showing that you could make these mortgage payments for anywhere from 6 to 12 to maybe 24 months. So don't just think because you've got 10% down and that's all the money you have that you can get rent schedules and qualify for it. There's going to be heavy layers, especially this year, June 2020, with reserve requirements from a risk standpoint.
All right, Addy, so do you have any insight in current local programs that are available and just some of the things to just look for in the fine print when pursuing kind of special incentive programs for either first-time home buyers or neighborhood programs? Talk to us a little bit about that.
Yeah, great question, Krystin. So out there, that's the most 100% the question I get from what programs are out there available to me as a first-time home buyer. I even see people like, we don't want to put my girlfriend on here because she won't be a first-time home buyer. And I think that there's just not clear answers to what's available. So one thing to know is every lender or company are going to have access to different programs. So if, say, it's a grant program, like a $5,000 grant toward closing costs or whatnot, that's just not available to everyone in the world. So they make the list short for a reason, because there's only so much funds available. So one thing I would understand too is, if you're building out a long-term plan and you want to utilize a program, the grant funds, they come and go. So you could talk to a lender one day and then come back 5 months later and be like, hey, we're ready. We have this money and we're going to get your grant. And the company could be like, I'm really sorry, but we're out of grant money. It happens quite often. So there are things like in our neck of the woods, there's the Oregon bond, there's the Washington bond, and there's actually a class that the lender has to take to be approved for those products. I recently took the Washington bond one. However, my company right now isn't doing the bond program. So you really got to check in with different lenders and see what the options are. But those bond ones are great. There are some zero down financing that is starting to come back, where you're taking advantage of a first and a second, which goes back to some of my remarks of, is that the best strategy for you? Is you're getting into a house with zero equity? It could or it couldn't. Everyone's situation is different. Some people just, that's the product they apply for. Generally speaking, though, going to what Jarrin and I were talking earlier, is there are some basic first-time home buyer advantages regardless of programs. So first and foremost, defining a first-time home buyer is not having interest ownership in a property within the last 3 years. Not a lot of people know that. So if you bought a home 4 years ago, dude, you'd be a first-time home buyer again. So you are re-eligible once again. So without any specific programs, you instantly have an advantage of being able to use a conventional loan at only 3% down versus the minimum 5% for anyone else in another status. So not a lot of people know that. Huge advantage. So there's a couple more details there. 2 programs that I like that aren't dependent on grant funds, they're stable, are Home Ready and Home Possible, which are Fannie and Freddie programs. And actually, I believe both of them this year, you don't even need to be a first-time home buyer to be eligible for those programs. So they're really great. What those give you are a reduced interest rate typically, and then a reduced mortgage insurance premium. So mortgage insurance is required for all whom put less than 20% down on their home, right? And how that monthly cost is determined heavily by your credit score. So if you've got a really high credit score, you're going to have a much lower premium with your mortgage insurance. Swings from like $90 a month to $350 from the spectrum of 8 to mid 600s. But those programs allow for a reduced mortgage insurance cost, which consequently lower rate, lower mortgage insurance cost, lower monthly payment. So I always like to be like, well, what's great about those programs is you're doing 3 to 5% down, and you're getting terms that are more adequate to an individual putting like 15% down. So that is an awesome thing to take advantage of. The only preface on that is their income capped. So it's per area medium income, 80%. And we could add a link, or, you could reach out to us and we look it up per property. In our neck of the woods, as of right now, it's roughly $72,000 per the applicant capped for the income. So if you exceed that, you wouldn't be able to use that program.
I mean, this is always a good interview question because it's such an easy softball. Like, is there a question you wish we would have asked you that we didn't ask you?
No, we did a really well-rounded. I'd say I'm extremely passionate about starting the process with agent and lender. I think that there's a lot of advantages that save you money that doesn't necessarily look on paper or on terms by having someone from start to finish.
And having that team.
A team. And I see people get into contract way faster when they have the financing figured out. So And I'm not pitching myself. I'm not pitching anyone. I'm just saying, like, if you're going to do and it's never too late to start, because like, say you're like, oh, I'm 2 years out. You should have a consultation with an agent and a lender and figure out maybe it's some credit stuff I got to work on. What are some 3 things I can do in the next year to get my credit score from 680 to 780? Because I can help people with that. And just the advantage of taking that consult, you're going to learn so much that's unrelated to real estate. Like, how could I lower my auto loans? How could I consolidate my student loans? Should I pay them off or should I not? I just think, starting now is never a bad idea.
No, I mean, I think the earlier you start, you know what you're going to qualify for. You're going to shop strategically. You really don't know what you're shopping for until you know what you can borrow.
Yeah.
Yeah, 100%. And I think too, like, I just am so amazed of how many people get into contract, just generally speaking, get into contract and they have no idea. They have no idea what their monthly payment was going to be. They just know they were approved for X amount of a loan. And there's so many variables with property taxes, insurance, closing dates. Like, I just really advise people to have that relationship and know your options. I love building out spreadsheets. I always do a 3 to 5 different option spreadsheet prior to offer, where it's like, here's the $5,000 increments, so hey, this is what the agent needs to negotiate for me. This is what I'm expected to pay for. This is what my monthly payment's probably going to be.
Totally.
I love a good spreadsheet. I do.
God, I love the spreadsheets.
Mm-hmm. Thanks for tuning in. We hope you enjoyed the conversation with Addy. I think a lot of times home shopping, the financials can be a little overwhelming for people.
Yes.
And so the thing to know, though, is you really can't seriously start shopping for a home until you know what you've qualified for, unless you're paying cash, which is not the majority of us. So thanks again to Addy for taking time to sit with us. Keep checking back here for more videos. We've got our Portland market updates coming in probably next couple weeks here for June. June data in July. So stay tuned, guys. Like and subscribe.
And more than anything, you probably just have a lot more questions. Feel free to drop questions in the comments below. Like and subscribe to our page so you can get more videos just like this. And reach out to us anytime. We love hearing from you. We would love to help you out if you have needs in the Portland metro area.